Good afternoon. My name is Chris Konetsky, and I'm president and group publisher here at BPC, which publishes the business record. Welcome to our final Project 515 of 2025, our final event of the year for business record and DSM. And today's event is being brought to you by our presenting sponsor, Midwest One Bank, and our supporting sponsors, Iowa Finance Authority and Excel Group. We're happy you're here with us today to talk about a really important topic. It's our goal to help you do business better. You all are the reason that we do what we do, and this series is designed to do just that. Our Project 515 series on real estate and development focused virtual events dives deep into three specific subsections of the industry: retail, office, and of course, we're going to be talking about housing today. The series has a goal of illuminating future challenges and trends throughout the year, while also amplifying discussions with the region's key stakeholders that do business directly in those sectors and with those leaders who are dependent on the health and vitality of the real estate industry, which so many, of course, are. Coverage of today's discussion, all of them have appeared both in written form, video form, across Business Record and print, weekly CRE e-newsletter, businessrecord.com, and social platforms. We really take these events and try to use them as opportunities not only to learn, but then, of course, to educate our audience. So we're excited for today's opportunity. We've got a great panel lined up for you to peer a little bit into the future of what the housing sector is going to look like in 2026 and beyond. We've got a lot to discuss today, and we're excited to get going. Before we begin, we want to take a moment to thank the sponsors who are helping make Project 515 possible. Our presenting sponsor, Midwest One Bank. At Midwest One Bank, community is at the heart of everything they do. And since 1934, the bank has embraced taking care of their customers in order to help their customers and communities succeed. Today, we've got a brief video from Devin Boyer, Central Iowa Market President at Midwest One Bank.
Hello, I'm Devin Boyer, Market President at Midwest One Bank, and we are honored to be the presenting sponsor of the Business Records Project 515 series with a focus on real estate and development. At Midwest One, our mission is simple: taking care of our customers and those who should be. That means being a true partner in building strong communities where we live and work. Real estate and development drive growth, create opportunities, and shape the future of our community. We know that strong financial partnerships are the key to making these projects a reality, and we're committed to supporting the businesses, developers, and families every step of the way. Project 515 provides great insight, perspective, and a platform to explore these topics. We're proud to be part of this important conversation, excited for the ideas and connections that will come from today. Thank you for being here, and please enjoy the event.
A big thank you to Midwest One for their presenting sponsorship that helps anchor this series. Couldn't do it without their support, so thank you, Midwest One. One of our supporting sponsors for Project 515 is the Iowa Finance Authority. IFA is helping to create opportunities for Iowans, communities, and businesses to thrive by connecting people with affordable financing resources. With us today, please welcome IFA's Communications Director, Ashley Jared. Ashley, I know this topic is really important to you at IFA, so I'll turn it over to you.
Great. Thanks so much, Chris, and the entire Business Record team for bringing us all together for this very important topic. I know on days like today, I'm especially grateful that we can meet virtually and not have to bear the windshield outside as well. This topic is very, very near and dear to our hearts, though, and actually very timely. Our office just received our updated forecast numbers that shows that we'll need about 18,000 new housing units by the year 2030, the majority of those being single family. We also show that based on building permit trends, we are braced to meet that goal. Now comes the fun part where we can work with community and state leaders to make sure that we're making strategic decisions to make sure we're building the right types of housing for the right income levels in the right areas of the state. Before we get started, I wanted to give a couple of shout outs to some familiar faces. Curtis Brown, City of Urbandale. Congratulations, City of Urbandale was named an Iowa Thriving Community this year, thanks to their amazing work on being innovative and welcoming for housing for all income levels. So hopefully he'll give a shout out to that in his talk today. Also, Bob Hartwig with IBMC is one of our amazing partners on our homeownership side. They make lots and lots of dreams come true in partnership with IFA for our mortgage and down payment assistance programs. We truly could not do what we do without the partnership of so many great individuals like Curtis and Bob on the line. With that, I will turn it back over, and I really look forward to hearing from this great panel. Thanks, Chris.
Well, thanks, Ashley, and thanks for the work you and your team are doing at IFA to help solve Iowa's housing challenges as we move forward. Lastly, a new supporting sponsor for today's Project 515 event is the Excel Group. The Excel Group is a leading independent Midwest insurance agency providing business insurance, agribusiness, personal insurance, employee benefits, and financial services. And with a proactive client-first approach, they tailor solutions that reduce risk up front, protect assets, and support long-term success for individuals, families, and organizations of all sizes. With us today is Dustin Toner. He's a sales executive with the Commercial Insurance Division. Welcome, Dustin.
Yeah, good morning, everyone. I'm Dustin Toner. I lead the real estate services practice at Excel Group. We're excited to sponsor today's event. Excel Group is a privately held top 100 insurance agency with a major presence right here in Des Moines. Past 5 years have been uniquely challenging. Industry consolidation is notably happening amongst insurance brokers, especially private equity-backed roll-ups. This is reducing the level of service that many real estate firms receive at the exact moment insurance carriers are struggling with profitability. The net result, you're paying more and you're getting less. Layer on top of that, the tough credit environment, rising property taxes, vacancy concerns, persistent inflation, and the pressures are very real. And then even worse, they're amplified by the weather patterns that we've been seeing. We're seeing larger, more frequent hail events throughout Iowa. We're seeing more intense tornado activity. Just look at Harlan in 24. And then you get into the catastrophic convective storms. Most of us had not heard of a derecho prior to 2020, and yet we've had several since then. With carriers struggling to return a profit in Iowa, there's been a mass exodus. A lot of carriers are moving out of Iowa, not insuring property anymore, leading to higher deductibles, less coverage, and in many cases, premiums have doubled over the past 4 or 5 years. End result is an uncontrollable expense line in many viewpoints as we have those conversations. At the Excel Group, we get it. We're built to help. Our real estate practice focuses deeply on this sector day in, day out. We've positioned ourselves to bring you transparent compensation, extensive market reach, and a strategic risk management partner who understands how insurance decisions directly influence net operating income, your asset value, and long-term stability of your portfolios. We're here to help navigate today's market, protect your assets, and gain a competitive advantage. Thank you and enjoy today's panelists.
Thanks, Dustin, and thanks for participating today and helping support today's event. If you could do something about the cold for us all, I think we'd appreciate that as well, but maybe your insurance can help with that as well. So thank you again for helping support this, and thank you to Midwest One and Iowa Finance Authority as well for your support of the series. We've got less than an hour to cover a lot of ground, and I know Kathy has got a great group lined up for you. You can participate in today's discussion as well, too. At the bottom of your screen, you can see you can participate in the chat or the Q&A. Both are great places. If you have a question, something spurs a thought, or a resource that you want to share with the panelists, you can go ahead and add those questions into the chat. We might not be able to get to every question, but that can help guide some of our discussion throughout the course of today as we go. To kick things off and introduce our panel, I want to introduce our senior staff writer, Kathy Bolton. She covers real estate and development with a specific lens of housing. She looks at workforce and also education for the Business Record. She's going to be leading today's discussion. She put together the panel. She always does a great job. Kathy, I'll go ahead and turn it over to you so you can take it away.
Thanks, Chris, and welcome everyone. And thank you to our panelists for taking time out of their busy days. Today we're going to, Project 515 is going to discuss housing, as we said, and our goal is to explore the opportunities and challenges in bringing more homes and more affordable homes to the greater Des Moines area. With us today are 5 folks from different corners of the housing ecosystem. Curtis Brown, who's Assistant City Manager of the City of Urbandale. Robert Hartwig, President of the Iowa Bankers Mortgage Corporation. Chris Pickard, owner of Sage Homes and President of the Home Builders Association of Greater Des Moines. Scott Steelman, a realtor with Iowa Realty Company and the incoming President of the Des Moines Area Association of Realtors. And Matt Weller, Vice President of Development for Hubbell Realty. Thank you all for joining us. Bob, we're going to start with you. First, why don't you give us an overview of what Iowa Bankers Mortgage Corporation is, what it does, and its relationship with the Iowa Bankers Association?
Well, certainly, and thanks, Kathy, for having me on today. IBM, or Iowa Bankers Mortgage Corporation, or as we refer to us as IBMC, is a wholly owned affiliate of the Iowa Bankers Association. It was formed in 1979 as a secondary market aggregator to be able to buy long-term fixed-rate mortgages from all the Iowa banks, and then we service those for basically primarily for Fannie Mae. Now, today, we service about 66,000 mortgages for a total of just short of $10 billion. 74% of those are in Iowa to community banks in Iowa, and the other 26% are in basically our surrounding states. And we service both for Fannie and Freddie, and also for the Federal Home Loan Bank of Des Moines Mortgage Partnership Finance Program. And the reason we're in existence, as of several of our competitors, is that banks don't tend to portfolio or hold on their books a long-term fixed-rate mortgage because it creates too much interest rate risk for the bank. So that's why Fannie and Freddie were created in the 70s, to create that secondary market. And that's what we basically do. We do not have a retail presence. We are wholesale only. So we buy brokered loans from banks, as well as loans from banks on a correspondent basis. And we have 91 full-time employees here on North Park Drive at our building in Urbandale.
Thanks for that. So from the lending side, what's the most important trend you're seeing in today's mortgage market, and how's it shaping the buyer's behavior?
Well, one of the things that we're seeing just in the last 6 to 9 months, and we have Chris, Scott, and Matt, who are from the real estate and building community as well, that maybe later can chip in on this as well, because they're going to know far better than me. But when COVID hit and we had rates down into the twos for a while, we had the biggest refinance boom in 20 and 21 that we had ever seen in the history of our company. And then after that, in 2022, we saw a very swift rise in long-term fixed-rate mortgages, to the point where a lot of people really felt like for a while they were rate locked. And we didn't see a lot of movement in housing, and inventory was very constricted, even in the metro. It was extremely constricted, and it still is in a lot of our smaller communities. But I would say in the last 6 to 9 months, we're seeing a big improvement in housing inventory across the metro, as well as some improvement, although it's still tight, in our smaller towns. And I think the main reason for this is a lot of home buyers at this point are kind of feeling like, okay, after 3 years of these rates, within the last 3 or 4 months, rates have started to moderate downward just a little bit. We're in that 6% range for a 30-year fixed rate mortgage, and I think a lot of home buyers are feeling like, okay, this is where we are, and this is probably where we're going to be for a while. And if you look back in our history over 60 years, that 6% mortgage is really very close to the median of where we've been historically over time. So I think that's helping free up inventory as people are starting to move up and trade houses.
I'm glad you said that, because I was going to ask you what sort of the average rate has been over the past few years. I am old enough to remember when it was 12%. So 6% seems pretty good, but not when you're comparing it with 2 or 3.
Yeah, when I started, I was a real estate lender before working here at a bank in Northwest Iowa. In the late 80s, I remember our first 1-year ARM was 9.9%. And it was a big deal at the bank because our fixed rate loans were 12 and a half. So yeah, we've come a long way down since then.
So are you starting to see different types of financing being offered to borrowers?
Actually, yeah, we have, because during, in 2022, when rates went up, what we call in our business the yield curve, which is the spread or difference between the 10 and the 2-year treasury rate, actually inverted. And that doesn't happen very often. But what that basically means is there was a lot of people at the time that were kind of betting that the economy was going to go into a recession, which actually never really happened. So for a time period of 22, 23, and for a good part of 2024, fixed rate loans were actually cheaper than adjustable rate and balloon mortgages that are typically more popular for first-time home buyers. Well, now that yield curve, or that spread between the 10 and 2-year treasury, has reverted back to a normal slope. So what we're seeing over the last 6 months or so is we're seeing a larger shift with our customers back to more portfolio lending, where those 5, 7, 10-year arms and balloons are becoming much more popular, and banks are starting to portfolio loans again and keep them. And those loans are a lot more popular with first-time home buyers, because if you can get that spread on a 7-year arm, at 50 to 60, 70 basis points, or about between 0.5% and 0.75% from a 30-year fixed rate mortgage, a lot of those buyers will take those loans. Because your average time in a first-time home is, usually around 5 or 6 years. So those are perfectly good products. I like to tell people our banks are both our customers and our competitors, because when we get like this in a normal market, a lot of times they will keep those loans that 2 or 3 years ago they were selling us. So that's just happened in the last probably 6 to 9 months.
So is that a good thing? Is that getting more home buyers into the market?
I think it is a good thing, and it's also good for the economy that we have a normal slope to the yield curve, because a lot of people think that long-term fixed rate home loan rates are controlled by the Federal Reserve. They're not. Long-term fixed rate home loans are keyed off of the 10-year Treasury. They usually float about 2 percentage points or 200 basis points off of the 10-year Treasury. So the Federal Reserve, what they do is when they change the federal funds rate, that does impact auto, credit cards, and short-term loans. But I think for the economy long-term, it's good to have that normal slope in the yield curve. So yes, plus the fact that it makes homes a lot more affordable for those first-time home buyers, because a 0.5 or 0.75% change in the interest rate does matter.
Mm-hmm. So what do you see as the biggest barrier for a home buyer today in qualifying for a mortgage?
Well, one of the things is we would like to see a continue, and people are already doing this, but I think we want to see a continued emphasis on borrower education. Because an educated buyer is much more impactful and meaningful than layering on of new regulations that can be restrictive and can stifle innovation, at least in our market. Because there's a lot more today that buyers have to deal with than they probably had to in the future. And Dustin from Excel alluded to it. One of the big issues that we're having in the last 2 years is an incredible increase in the cost of homeowners insurance. What used to be $1,000 annual premium on your typical median house in the Des Moines metro is now upwards of $3,000 a year. So there's a lot more to purchasing a home today than just the down payment. The buyers need to focus on that cash to close. So the homeowner's insurance premium, things like, how are they going to furnish the home? There's a lot of stuff besides the down payment that come into play that have gone up in the last couple of years. So I'd say that's probably one of the larger barriers.
Okay, well, thank you. That gives us a good sense of what's going on the financing front. Now let's turn to the supply side and hear about home building. Chris, thanks for joining us. Put on your Home Builders Association hat and give us your perspective of the current state of home building in the greater Des Moines area.
Yeah, absolutely. And thanks, Kathy, for having me, and thanks to all the panelists for taking the time to get on here and talk about it. Our current state is a little bit of a mixed bag. Permits pulled through the third quarter of this year, we're down about 21% compared to the same time frame last year. And the average valuation of a single family permit out there right now is a little over $400,000. And that valuation is not necessarily sales price, so that points to a pretty grim reality about the state of affordability in single family housing specifically. Despite those negatives, we're still in a good spot to be. Des Moines is still holding up pretty well compared to similar markets, both in affordability and stability of sales. The drop in permit count, I think, is a couple of things. I think the first thing is it's reflective of a softer than expected demand through the middle part of the year here for home builders, but it's also reflective of a building community that has been most successful in downshifting in response to that lower sales volume. We've got not only good builders and developers, but our contractor and trade base is in good shape when compared to other areas of the country. And we should be ready to respond pretty well when sales and unit count are able to pick back up.
So you talked about single family permits. What about townhomes? Is there a shift to more townhome building?
So we're seeing about the same amount of townhomes that we saw last year. Valuations on those is a little bit better, right? Average valuation on a townhome permit right now is hovering around 250,000 per at the end of Q4 for the year. But the problem that we see with our customer base anyway is, when people think of their first home, a lot of people are looking for that single family unit, and townhomes, although they can help bring that affordability back in, they're not what a lot of people picture when they think about, hey, the American dream, the picket fence, the dog in the backyard, and all that.
Mm-hmm. So how are home builders sort of balancing the cost and quality and affordability when they're going about building those new homes?
So it's definitely always a struggle, right? The instability of the trade environment this year has been tough, right? Kind of a continual threat of material shortages, increased prices. We have seen a slowdown in knee-jerk reactions, right? And everybody's getting a little bit better at discerning the noise and the actual issues. We still do have to pay attention to everything that we're doing every day. Make sure we're cutting waste, make sure we're doing bulk buys, setting up more meetings with our trade partners and our vendors to try and find alternatives and backups in the event that something does become unavailable. We're stepping up job site presence and management, trying to curb waste and misuse of products. For the workforce housing side, right, the more affordable side, we're seeing a push from developers for smaller lots. We're seeing a move further out of the metro's core into some smaller communities where land prices are a little bit more reasonable. Development costs can sometimes be a little bit less. We're also seeing builders get some traction in offering incentives to help people better afford their payments, right? Whether that be in the form of rate buy downs, closing cost credits, or sometimes just flat out discounts, right? All of those are keys that we're trying to utilize, or levers we're trying to pull in the search for getting more people into more homes.
So you mentioned material shortage. I know during the pandemic, there was a lot of shortages. What specifically are we seeing shortages of now?
Honestly, a lot of it this year has been bluster. There's been a lot of talk and a lot of people scared of shortages. We haven't seen a ton of stuff come to fruition yet. I mean, even though we've got talk about, increased tariffs, the lumber market has been such that, prices, we've actually seen those prices decrease a little bit. Flooring is a big one from overseas that is still kind of continually teetering on the edge. But so far, thankfully, we haven't seen a lot of stuff that has really impacted us.
So when home builders and designers go about designing that home, what are some things they're doing to manage costs? What design elements are they either eliminating or adding that brings the cost down?
I think some of it is getting rid of some of the more frivolous things, right? Going from a tile shower floor to a fiberglass pan floor helps cut a couple $1,000s, right? But for the most part, we're seeing folks not wanting to sacrifice style and quality. We're trying to deal with it on the building side of just really trying to bulk up our pre-construction processes. Not so much innovation as just getting back to a place where, we've kind of reined in some of the sloppiness and really trying to refocus on organization and best practice. There are some really good advancements that are being made in design and purchasing software that's also helping to cut back on waste. But for us, that's been the key, is just really doubling down on our organization and our process and trying to do better with what we've already got.
Are there any big obstacles that are preventing builders from producing enough homes, especially at that affordable, attainable price level?
Yeah, there's a few of them, right? The top three that I can think of are land, capital, and compliance. Land costs have rolled up significantly in the last few years, with rates being where they're at, both from a mortgage lending and from a commercial lending perspective, right? Bob talked about it's harder for folks to make that mortgage payment. Those rates are higher than they have been in a while. But for us builders, right, to go out there and build speculatively, the higher lending environment means we've got about half the amount of time for that house to sit on market before we start to face margin compression there. Compliance is also a big thing. Ever increasing cost of regulation is a huge contributing factor to what we see. The costs on the development side that are associated with stormwater regulation and increasing requirements for road lifespan are huge. We've got a multitude of building code and energy code changes that have come through in the last few years, and they've had a drastic impact on costs. And then the other thing that we faced in the metro here over the last few years is cities kind of going through updating their design standards and building standards. And sometimes that's not always done with the interest of life safety in mind, but more of getting to a certain aesthetic that somebody wants to maintain, right? And as we're forced to continue to add things and add footages and bigger garages and basements and all that stuff, these are things that the end buyer might not care about that just continue to drive our costs higher and higher.
You said home building is going further out to smaller communities. What smaller communities are benefiting from the move?
So as you think about like more of those bedroom communities, right? We've personally seen a lot of success in areas like Monroe. Oskaloosa has been one for us. You know, your Granger, not Grimes, but Dallas Center, you know, getting just a little outside of those majorly growing, cities has been a good spot to pursue a little more affordability.
Okay. Well, thank you. And now let's talk to someone who connects buyers and homes every day. Scott, you're able to see what buyers want and what's actually available. What kinds of homes or neighborhoods are buyers demanding most right now? And where's the inventory falling short?
Okay. That's exactly a great dovetail with what Chris was saying, that we are looking. I started using this phrase, Des Moines within the last 5 years became one of these drive until you can afford the payment locations. We weren't that. We didn't have to leave the metro as much. Now we do find ourselves following Chris's lead and going out as far as Stewart. There are builders in this community, in our communities, that are going out and building in Greenfield and building in communities that you wouldn't necessarily see on their radar. Pella, big communities like that are really seeing a growth. So as a realtor, we're seeing what the Des Moines Metro typically carries as inventory, but the clients are also asking us to look further out just because of the price point, and they can't afford more. To a little bit of Bob's point, we had to rewrite our purchase agreements to include a line in there that said the offer was subject to insurability. So that's something that's new for our community to have to be concerned with day one, so that we didn't put our clients in a position at closing that suddenly all the details come together and they just can't make that project work.
That's interesting. So are we in a buyer's market or a seller's market?
So the computer spits out that it's even. The statistics look like this. In April of this year, the Des Moines Area Association, our inventory cap went over 4,000 for the first time since 2022. And we've maintained that over 4,000 level. This morning, we were at around 4,322. That's a little more than we've been carrying the last couple of years. The breakdown of that is that let's call it 4,300, 2,900 are resale homes and 1,300, almost 1,400 are new. Break down into the new a little more, it's basically 1,000 new homes and 400 condo townhomes. So what Chris was saying about the permitting of lesser expensive townhome condominium, we started seeing two buying pools for that product, and that is the retiree that's coming down out of a older, larger home, competing with first-time home buyers for that townhome condo price point. And so a lot of those developers and builders started building a little better product, and the price points kind of increased with that bigger footprint, if you will. Mm-hmm. And that sort of caused us to rethink some of the buyers that we would naturally have had for that kind of a product.
So my neighbor put their house on the market and the next day it was sold. How long are houses staying, especially, those in the 350 range? How long are they staying on the market?
Yeah. Your neighbor's home must have had some updates, and that's going to be the key to the buyer's eye. A home will sell immediately if it is in the right school district, if it has enough updating. We have to be very careful, back to the insurability part of this, of our roof ages now, because insurance companies have given us a heads up that if a roof is over 10 years old, there's going to be a premium on that roof, and the homeowner will have to pay for more of the replacement if there is a replacement need in the future. So those homes that go on the market and sell almost immediately are either perfectly priced, have a buying audience that is waiting for something like that to hit the market in that location, or they've just absolutely made someone's day by having the exact layout, if it was, or the utilities and upgrades that they needed so that they weren't spending money in the future. The no fun money that I call it for windows and roofs and appliances.
So what's the biggest misconception home buyers have about what they can afford or qualify, especially given what the interest rates have been lately?
I love this question. Again, in the last 2 years, loan officers have become psychiatrists. And the sooner we can put a homeowner or a prospect with a lender, they can look at their whole package, their debt, their current income, the potential of having children and where that's going to put them in financial obligations, so that the lender can show them day one that this is really where you do qualify, but by adjusting this truck payment or this Airbnb usage, you can qualify for more. So we do find that the homeowners that we're seeing, our world has changed significantly. Now, if you called me today and wanted me to show you homes, we have to sit down and have a counseling session so that you can understand how the real estate community gets paid, and our reimbursement from the buyer or the seller is illustrated. So it's clearly pointed out. Same thing is happening with the buyers now with lenders, and they're giving them the full upfront view so that they're a little more educated, not trying to give them the fire hose of information at day one, but we certainly like when we meet with a homeowner to know that they've actually been counseled about their credit and they do understand what they can afford. Or if they're in a home and they're selling, what that equity is going to look like and what they should do with that. The lender's going to tell them where to put that the best, rather than just pouring it all back into the next purchase. We love that too.
Okay. So from your perspective, what changes, either from the lending, building, or policymaker point of view, what would help improve the home buying experience or affordability for home builders?
The pipe dream for us, a couple of weeks ago was the National Association of Realtors convention, and there was this conversation about those people with the 2% and 3% mortgages and their ability to either sell their current home and the buyer absorb that mortgage rate, or them to carry that to the next purchase. It's a dream. It can't be done. The institutions that are gotten involved in all those lending decisions couldn't unravel that to make that occur, but that would be our pie in the sky if we could do that. There was some national buzz recently about a 50-year mortgage, and that's just would be an awful scenario. The lenders, I think, will tell you that there's a better product than a 50 for almost anybody, and it really is buying within your means. There are, hopefully in our community, we're very fortunate in Des Moines. We do have values ranging from entry level right up to the $1 million plus, and we're not really short of anything. But there are markets that we met with at the National Association that their entry level product is $800,000, and the income you have to have for that and the way you have to qualify for that would just be amazing.
Yeah. Okay. Well, thanks, Scott. That's a lot of good information. So let's turn to Matt now, who's got a handle on the multifamily sector. Matt, thanks for joining us. What trends are you seeing right now in multifamily, and how have renter preferences changed in the last few years?
Yeah, thanks for having me, Kathy. Good to be here. I mean, the word we've been hearing for years is affordability. So what does that actually mean, and what have we seen? John, a colleague in my office here, has phrased it as it's our renters are pairing up into roommate situations, or paring down into smaller, more affordable units. So what does that mean? It means instead of renting a 750 square foot one bedroom apartment, they're looking at a 675 square foot one bedroom apartment. As much as I like to think renters rent on a per square foot basis, because that's how I look at it from a developer standpoint, they just look at the total rent cost. So what that's meant for us is, designing and developing more efficient units. There's a jump from a one bedroom or an efficient one bedroom to a studio. That's a kind of a different living type. But going from a 750 square foot one bedroom that we saw for years down to a 650 is something you're going to see more of. A statistic that was put in front of me here is looking at the same sample set of apartment units in our portfolio over the last 12 months, there's been an increase of 12% in number of leaseholders per unit. So that supports the theory of, more people are doing roommate scenarios, roommate situations. So yeah, that's what we're seeing there. And honestly, it's they're maxed out on what they want to pay for rent, but they can pay more. So the rent to income ratio has actually decreased over the last 10 years. People or their incomes have increased at a faster rate than what their rent has. They just don't want to pay more than, X number of dollars. And that's what they're doing.
So what amenities do renters want to have when they rent an apartment? What's different than maybe 2 or 3 years ago?
Yeah, I mean, pool and fitness are still far and away the most requested. We try to have a pulse on what renters actually want, what they value through some surveys, and those run away as the number one request. Dog park has really kind of upticked in the last 5 years, to the point it was kind of a novelty 5 years ago, and now it's kind of an expectation, which from a developer and owner side isn't a bad thing if they associate value to it, because it's minimal operational cost. And in a period where we're looking at, all of our operational costs very closely, it doesn't add much with a dog park. Pool, on the other hand, you got high operational costs. You've got to have a lot of units to help support and dilute that cost. Otherwise, the fitness, we've been doing it for a long time, and it comes down to, how to differentiate, how to make it a little bit better experience for the renter. We've got a project downtown Link 4 here that we'll be delivering in a few months, and we're putting a sauna in there and a Pilates studio to complement existing fitness facilities we have in that development already. So just some unique things that, isn't for everybody, but some people attribute value to them, and so we're willing to take a look at them.
One of our viewers, Carol, is wondering about indoor bike storage. Is that something you're adding or considering adding to your projects?
Yeah.
And is it demanded?
On a majority of our urban properties, we do have dedicated bike storage rooms. If you think back to Level, when we toured that a year or so ago, there's actually bike storage and kayak storage in that property. So that's been something we've been doing a long time for our urban kind of one building type of development. Now our garden style developments with multiple buildings, we've done less dedicated bike storage just because there's more sprawling. And so we, probably need multiple bike rooms. So we haven't done that recently, but yeah, it's a real thing. People bike, they have bikes, and they need to put them somewhere. So if we don't have detached garages for them to rent, then yeah, maybe that's something we take a look at.
So are there any, when you talk about affordability, are there any cost drivers or regulatory hurdles that are making it difficult to build affordable multifamily units?
Yes, there's always new things that add costs, and a lot of them are attributable to energy standards or just generational building codes. Some of them are very city specific, that add some costs. A couple top of mind here, parking ratios. As an owner developer, we need to provide adequate parking for our residents, or they're not going to live there. Like, we're already incentivized to provide the right amount of parking, but a lot of municipalities come over the top and say no, it's a prescribed ratio, which can be fine or it can be a problem. If it's a per unit, if you need two parking stalls per unit and you've got a development of all studio apartments, you're way over parked. On the other side, if you have all 3 bedrooms, you're going to be potentially under parked. So that kind of forces our hand on what we have to do, and parking is not inexpensive. Garages is another one. Again, we strive to provide the appropriate number of garages. If we have too many, then the rent goes down and you end up losing money on building garages. So there's sprinkler requirements for life safety that vary from municipality to municipality. I don't, they're well intended, so that one's a little harder to push back on. But landscaping, materiality, percentages of brick and stone, metal panel, and then balcony requirements. I mean, there's municipalities that say every unit has to have a balcony, and it has to be 4 foot by 8 foot. If you're trying to build affordable 500 square foot units, it's hard when you're adding $8,000 for a balcony on that.
So talk about some of Hubbell's developments. We talked about developments that's going on, more development going on further out of the center of the metro. Tell us where Hubbell's building at, and then come back to line 7, what you're doing in Urbandale.
Sure. We have some development in Omaha. I won't touch on that because this is a 515 panel here, but in the Des Moines Metro, started downtown at Gray Station. We've got, I mentioned Link 4, it's 135 apartment units complementing the previous 3 phases of Link. That is well underway, should deliver here in the next 3-4 months. Adjacent to that, we have Telus Condos, which is a 32 unit condo building at a lower price point. So I think it's starting at $245,000 a unit. We've got 9 reservations already on 32 units, and we just are finishing framing the first floor. So a lot of interest there. And then adjacent to that is a clubhouse to service the condo building and the for sale townhomes down in Gray Station. Moving south in Norwalk, we are well underway on a project called Cowway. So that's a combination of apartments and townhomes that we're excited about. I think that's going to be a good project. And then north in Ankeny, we have a project called Sienna Crossing, similar garden style apartment buildings, framing there as well. And then moving over to Urbandale, which you alluded to, which will be the segue for Curtis. Line 7, we have not started construction there. That's a unique kind of development agreement we put together with the city there to incorporate an affordability component. And Curtis can elaborate on that if he wants, but there's we set aside a certain number of units at an 80%, a 60% AMI in exchange for some grant funding from the city, and it's kind of a win-win. We're able to have a mixed use or mixed price point development within the same development. It's not a one building that's all affordable and then one that's market rate. Everybody's together, and it was great working with the city to put that together.
Okay, well, thank you. And Curtis, that he teed it up nicely for you. Tell us about Urbandale's efforts to provide affordable and attainable housing.
Yeah, certainly. First, thank you, Kathy and Chris and the team at Business Record for pulling this important conversation together, and sincere thanks to the sponsors too, because this doesn't happen without all of them. So Urbandale is all of this is happening within the context of strong growth. In fact, got numbers from community development. We are tracking nearly double the 15-year average for new unit construction this year. So we should be just over 400 units constructed this year, single family and townhome. Urbandale, within the existing city limits, can still add 20,000 more people. That's about 50% of our population. And then with westward expansion, we can continue to develop more. So all of that provides opportunities for Urbandale to be innovative with housing and to deliver new housing types to the market. So your question was, what are we doing in terms of affordable housing? Well, first of all, I would say what we're doing is preserving what we call the naturally occurring affordable housing. So in our community, that is those neighborhoods east of 86th Street where you've got more moderately priced houses, but still solid construction and great opportunities in a good school district in shaded neighborhoods, plenty of access. So we're working to encourage homeowners to invest in their properties, create more energy efficiency. And then, of course, we are working on our revitalization of downtown, which is both a core commercial effort, but it extends several blocks from Douglas and 70th out into the residential neighborhoods as well. So we hope the approval of the downtown master plan, which happened this summer, will also have ripple effects out to the neighborhoods to really preserve that moderately priced housing that's still available here in the core of the metro, so very accessible. Also, picking up from the conversation with Matt just before here is we're partnering with developers in innovative and creative ways. So you can look at several projects that we've worked on here in Urbandale in the last several years. First of all, the view on Hickman converted the former Motel Relax into 60 affordable units on right on Hickman Road there in the core of the metro. We are also, of course, working on the Line 7 project out west. And then more recently, we've been working on the conversion of the former motel out at 108th Street and Douglas. So really focusing on that preservation of the naturally occurring affordable housing and then innovation and creativity with developers.
So tell us a little more about what's going on at 108th and Douglas with the former Econo Lodge. What did the city bought the land? Tell us a little bit about that.
Yeah, absolutely. We love talking about this project because it's been just an incredible example of partnership and creativity. So first of all, the why. Why did the city step in and do this at all? Well, really, there were three reasons. Number one was blight remediation. This property had become a troubled property over time, and there does come a point when the city needs to recognize that and take action, and so we did. So blight remediation was number one. Number two, our comprehensive plan, which I know many in the metro real estate community are familiar with, approved by the council just within the last couple of years. Our comprehensive plan indicated for that stretch, roughly between 106th, 109th Street on the north side of Douglas there, for comprehensive redevelopment, looking at a mix of housing types in that area. So second, we had the indications from the comp plan. The third reason we stepped in was that our city council has really put affordable housing goals out there. We want to create a high quality of life for anybody who wants to live in Urbandale. So there was an opportunity to acquire that property. We partnered with Polk County to get the property torn down so we had a blank slate. It was about then that we submitted an application for the Iowa Thriving Communities through Iowa Finance Authority, and that was a huge team lift across many departments within the city. So a team effort landed in the success that Ashley Jared mentioned at the top of the call here, and we couldn't have been happier. Beyond the practical benefit that Iowa Thriving Communities provides in terms of a more competitive application for low-income housing tax credits, it also really shined a spotlight on both the opportunity of the Douglas site as well as Urbandale's efforts in affordable housing. So another great example of partnership. So then, right after the Iowa Housing Conference, in fact, the day after, we released a request for proposals out to the development community for proposals to redevelop that site. And it's interesting, Kathy, what we did is we put very high level requirements on the development of that site. First and foremost, we wanted a successful project. We wanted multiple bedrooms. We wanted to serve households at or below 60% of the area median income. Really beyond that, we did not put a lot of constraints on it. And this is a theme I want to touch on, is we as a community are relying on the creativity and innovation of developers. We truly want to partner. And we were thrilled with the response. We got 7 excellent proposals back. I know everybody says it was hard to make the decision, but it truly was. And in the end, we ended up choosing the proposal from Volker Development, a Wisconsin-based developer. And that project really represented in a comprehensive way the highest value to our community in terms of meeting goals, serving families of moderate income, and of course also the financial return over a period of time. So that project that Volker plans, if they're successful through the LIHTC process next spring with Iowa Finance Authority, will bring about 50 units affordable at the 50 and 40% area median income level right there in Urbandale. So it's actually doing, if successful, everything that we planned. Remediates blight into redevelopment, follows the comp plan, and helps to meet one of the council goals for affordability.
Great, thank you.
I might also add, it has bike storage and moderate parking. In fact, we asked the developer, that looks like a lot of parking. And we said, we're willing to work with you on right sizing that. So another example of we do want to be in dialogue with the developers because we want a successful project.
Great, thanks, Curtis.
Of course.
Scott mentioned earlier the 50-year mortgage. Bob, I want to go back to you real quickly. What are your thoughts on that 50-year mortgage that's been batted around?
Yeah, let me put some color on that. I was going to mention that, and when you had me and Scott brought it up. Well, this is probably the conservative old banker in me, but the math on it's horrible. So let me give you some color on that. So I took our average mortgage last week that we have purchased this year, which is $275,000. That's across all the state of Iowa, not just the Des Moines Metro. And then I took a prevailing rate of around 6%, and I compared a 30-year fixed rate at 6 to a 50-year fixed rate at 6. And the payment is only 12.1% less than the 30-year fixed rate mortgage. And the amount of finance charge or interest that you pay over the life of the loan is exactly double for saving 12%. And this is the most galling fact that I came up with, is that looking at the amortization on a $275,000 mortgage over the first decade, you're going to reduce the principal on a $50,000 mortgage by about $11,000. And that just, to me, it's just not doing the buyers any favor at all. But, you know, again, some of this is my opinion, but it just isn't that much lower of a payment for how much more interest you would pay.
Okay, good information. So we're going to do a couple of quick round robin questions. We've just got a few minutes left. So what is the one thing you want the business community to take away from this conversation about housing? And Scott, let's start with you.
I guess I would say one of the keynote things to walk away from this would be inventories are up. And if you do have an interest in a specific area or a specific style of home, first thing you should do is ask a realtor to put that in the system so that you get emails daily about the product that meets and matches what you're looking for. The sooner you know about it, the sooner you can see it. Otherwise, you may miss the opportunity.
Okay, Curtis?
Yeah, as the former economic developer for Urbandale, now in Aaron DeYoung's capable hands. But what I would want the business community to know is that the cities and development community understand that housing is critical to the metro area's success. We need those businesses creating jobs and continuing to invest for the vitality of the industries that we work in, both for housing and our community. So I'd want the business community to know and be encouraged that we're working on this and want to provide great housing for the population that we are very fortunate to have increasing here in our metro.
Great. Matt? You're on mute.
I can't believe I did that. That's so. Somebody asked me once, when's the best time to plant a tree? And the answer is yesterday, right? I think the same thing is for affordable housing, naturally occurring affordable housing. You know, we need more 20 and 30-year-old homes. We can't fix that today. But building more tomorrow will help us in the future. So anything we can do to support that effort is what we need to do.
Bob?
And Scott alluded to this in his part. when he called, meeting with a lender, you have to be a psychologist as well. But if you're either a first-time home buyer or a repeat home buyer, get in and talk to a lender and your realtor as well, because we both mentioned this, but the issue of homeowners insurance today is a lot different than it was 5 to 10 years ago. And you can alter premium amounts a significant amount by changing deductibles and coverage limits and things like that. So it's just the way it's evolved over the last couple of years. It's become a significant cost in the transaction where it probably needs to be dealt with. And the better that you can educate yourself before you make that offer and go forward, I think the better you'll be.
And then Chris.
Yep, not not dissimilar from what Curtis had to say, right? Affordability in housing is not strictly the concern of the construction industry and the real estate industry. It impacts all of us. We need people to make our local businesses and our local economy run, and those people all need a place to live.
Okay. And then our final question is this. We've only got a couple minutes left. So just in 1 or 2 sentences, what is your outlook for the housing market of 2026? And Curtis, we'll start with you.
Things are strong. We expect continued growth. There aren't any structural or major barriers to success. I think we might, so we'll see stability with moderate fluctuations and responses to really what end up being federal level policy, from tax policy to tariffs to Fed funds rate, things like that.
Great, thanks. Chris?
It looks to me like things are on a manageable upswing, right? And the companies that continue to focus on improving their processes, their customer experience, and their product are going to do just fine as we navigate 2026.
Okay, Matt?
Yeah, regarding multifamily, vacancies, highest levels since 2017, 2018. Rent growth is stagnant. We see that changing in 2026. Supply slows, deliveries get absorbed, vacancy is going to go down, and rent's going to go up.
Okay, Bob?
Well, I'm not a macroeconomist, but I think short-term rates in 2026 are going to continue to moderate and go down a little bit. I don't see a lot of change in long-term rates. I think they're going to stay about the same as where they are today, so more the same.
Okay, and Scott?
I think the National Association of Realtors economists projected a 16% increase in productivity next year. That's a pretty strong number. I don't know if our metro is going to reflect that, but I certainly feel like we have the ability with the builders that Chris shoulder to shoulder with. They certainly do bring in a variety of product to market, and I think the move-in buyers that we see every year are probably going to become a bigger part of that buying pool than they have been. They won't. I don't know if Matt likes to hear this, but they may not rent right away. They may actually look for something to buy.
Okay, well, thank you. That a lot of good information, a lot to digest. Thank you all for taking part in the panel. And Chris, I'll give it back to you.
Right. Thank you, Kathy. Thank you, panelists. Appreciate your insights today. If you enjoyed today's programming and you want to dive a little bit deeper, today's just the start. We have so many ways that you can connect on this topic, many others related to real estate and development across a variety of different products. We have some upcoming events as well that you might be interested in participating in on January 8th. That'll be our first event of the year. It's the biggest networking event of the year. It's our Book of Lists unveiling. It's going to be at a new location at the Hilton Des Moines downtown. And we also have our economic forecast on January 20th. And our first Power Breakfast of the year on February 12th. So we hope to see you out there in person for those. Also, I want to make sure you're aware of our annual real estate magazine. Planning is underway right now. We're already working on that next year's edition. If you're interested in participating or you have story ideas, please reach out either my direction, Kathy's direction for stories. If you're interested in advertising in that publication, you can do so by learning more at businessrecordarem.com/advertising. Of course, if you want to stay plugged in each and every week, please subscribe to Commercial Real Estate Weekly. Kathy participates in putting that together along with Michael Crum, our commercial real estate reporter. There's no better place to stay connected in what's happening in the real estate development community than following along. It's a free e-newsletter each and every week on Wednesday. You can sign up at businessrecord.com/sign up. Of course, if you have any story ideas, you can reach out to Kathy or Michael Crum as well. If you have any feedback, please reach out my way as well. I want to give a final thank you for attending today. You've got a lot of places you could choose to spend your time, and so to spend it with us and learning, we really appreciate that. And again, thank you to our sponsors, Midwest One, IFA, and Excel Group for helping make today's programming possible. We too are a locally owned business, and your support being here today and supporting us by subscribing to our products really does help make what we do possible. So thank you again. Lastly, a thank you to Kathy Bolton for putting together a great panel, asking great questions. As always, we're really lucky to have her on the team helping lead discussions like this. So thank you, Kathy. And of course, finally, to our speakers, we're so grateful for you and your insights that you provided today. You each went out on a limb to help give us a little bit of understanding of what's going on in the market today. And we can't do events like this without folks that participate and share their insights with the broader audience. So thank you again. My name is Chris Konetsky. We're working hard every day on things like Project 515 to help build and strengthen the community. So if I or our staff can ever be of any help to you, please feel free to reach out our way. Thanks again, and have a great afternoon.